Hello, everyone. Can you hear me? I won't do the clap once. Whatever, I don't know if you're familiar with that tactic, but I'm not going to use it because you've all been very cooperative. Thank you for coming. Thank you for spending your Saturday evening in a university classroom. So my name is Kate Aronoff, and I am excited to be here and for a conversation tonight. I won't do too much preamble, but I do just want to do a quick thank you to our hosts at the Robert Heilbroner Center for Capitalism Studies at the New School for Social Research, and to Dissent magazine for hosting this event. One of my favorite little magazines. I am biased because I am on the board, but you should subscribe. And in fact, there is a little code that you can scan here at your leisure to save 25% on a subscription to Dissent, a wonderful journal of ideas and politics and culture. And I think this evening's conversation will hopefully be a great testament to the kinds of wonderful conversations that exist in the pages of that magazine. There's a really great new issue that is relevant to a lot of what we'll talk about here tonight. So check it out and subscribe. So without further ado, I want to introduce our panelists tonight. So Brett Christophers, author of this wonderful book we will be talking about, The Price is Wrong, is the professor of geography at Uppsala University. And Adam Tooze is a professor of history at Columbia University. They both have many other credentials, which you can find on the internet, and which will make themselves clear this evening. So I am just going to say that I want to use, I'll be moderating. My name is Kate Aronoff. I am a writer for the New Republic and a fellow at the Roosevelt Institute. So just to start off, I won't do too much sort of throat clearing before, but I want to use Brett's excellent book, which all of you should read, and I'll make a pitch for now, that there is another discount code. If you go to Verso Books, for The Price is Wrong, you can save 40% with the code Market Failure. These will be around. That's a very fun discount code, Market Failure. But to use Brett's book as a sort of starting off point to talk about sort of the politics of the energy transition and how close or not capitalism gets us to decarbonization and the ways in which it poses barriers to that. And so to start off, for those who haven't had a chance to read this book, which again, you should, I'll just say more nice things about it because it is really wonderful. I think if you are interested in the energy system, there is not a more concise and readable introduction to the political economy of how the grid works and entrees into what we might do to change it. I know it's been hugely useful for folks here in New York who have been working on the Build Public Renewables Act, both to get it passed and through the messy, sticky implementation process. And I think it's really sort of a tool that can be used and an educational tool, and I think can be really sort of potent grounds for organizing and just to get sort of into the weeds of the energy system, which, not unlike economics itself, can be intentionally sort of opaque and difficult to parse, but is not at its core so difficult to understand. And I think Brett really does a great service in this book, spelling that all out. So along those lines, I'm wondering if you might just start us off by describing some of the themes and arguments in your book, and then we can go from there.
Sure. Okay. Thanks, Kate, and thanks especially for doing this, and Adam, of course, as well. Thanks for being here, and thanks everyone for coming, and of course, thanks to the New School and Dissent. So I'll try in less than 10 minutes to do a kind of a very high-level run-through of what some of the main themes and arguments of the book are. And I think the place to start is just to say that it's a book about electricity at its heart. It's a book about electricity and climate. So the place to start is with what, I guess for many people in the room, maybe even everyone, but certainly many people will be very, very familiar with why electricity is so important in the climate context. So most anthropogenic greenhouse gas emissions are carbon dioxide. Most of those carbon dioxide emissions are from the burning of fossil fuels, something like 75%. And then if we focus in specifically on the burning of fossil fuels, the biggest source of emissions is electricity generation. So electricity generation is right at the heart of the climate problem as it currently exists. So that's the first thing to say. And the second thing, equally important, if not more important, is of course that electricity is going to get even more important because of the way in which the world is predominantly going about trying to decarbonize much of the rest of the economy, which is of course precisely through electrification. The basic idea being that you electrify as much as you possibly can across things like transportation, industrial processes, buildings, heating, and so on. And then you generate that electricity without burning fossil fuels. And so electricity is super interesting insofar as it's kind of the heart of the problem, but it's also seen as the heart of the solution. So it's difficult to think of anything that's more central to the climate problem and specifically to the energy transition as electricity. So that's why the focus is on electricity. I think the second thing to say is just to say a little bit about kind of how we are doing globally on the question of electricity decarbonisation. And this is one of those classic things where people look at this question in so many different ways, and it's very much, as I like to say, a kind of glass half empty, glass half full thing. If you're a glass half full person, and there are plenty out there, what you tend to hear from them is that we should be looking at these charts that show, rapidly upwards curving developments in terms of both investment in new renewable capacity and indeed the generation of electricity from renewables, and say, look, we're doing great. All of this is going much, much faster. We're on track. There's very, very, very good reasons to be positive about it. And then if you're a glass half empty person, I think the best way I can frame this is you would say, well, actually, I'm not even going to look at what's happening on the renewable side. I'm just going to focus on that aspect which actually causes the damage, which is, of course, is electricity generation from fossil fuels. And that's still going up too, irrespective of the growth in renewables. And for a number of years now, various different energy forecasters have repeatedly said this will be the year that electricity generation from fossil fuels and therefore associated emissions peak. They said it in 21, 22, 23. They said it this year, and it still isn't happening for all sorts of different reasons, not the least of which is, of course, growing demand globally for electricity of any type. But the fact of the matter is that it's still going up. So it's very, very difficult to suggest, I think, with any credibility that we are globally succeeding on electricity decarbonisation while generation from fossil fuels is still going up, which it is. And I'm sure any year now it will peak. It could be this year, it could be next year. But even then, if it only starts to go down slowly, we are still essentially failing. And for anyone who wants to look at some really useful but also sobering figures on this, the International Energy Agency came out, I think last week or the week before, with its latest World Energy Outlook, and basically made the point that everywhere in the world we are miles behind where we need to be in terms of the growth of renewables to hit net zero by 2050. And of course, that's net zero by 2050. That's not actual zero. And net zero makes all sorts of assumptions about the success that we may or may not achieve with various forms of negative emissions technologies. So we're a long way from succeeding, which raises the question of why. Like, why is electricity decarbonisation going much more slowly than, by any reasonable reckoning, we need it to? And that's really what the book attempts to address. And just before getting into what the book argues, I think one thing that's very important to put on the table is to kind of make it clear how the world is predominantly going about trying to do this. And of course, there's a huge amount that can be said about that. But I want to just point out three key things, which I think are broadly true. There are exceptions. Because it's important to understand those three things to understand why we are doing as poorly as we are. So the first of those is that for the most part, when it comes to electricity decarbonisation, we are kind of betting the farm on solar and wind. Now, of course, that's not to say that there aren't countries where nuclear is very, very important and will continue to be. It's not to say the same thing with regard to hydro, to even to geothermal. But for the most part, we are not expecting those technologies to do the bulk of the work to get us to where we need to go in terms of decarbonisation. For the most part, we are relying on solar and wind. So take, for example, nuclear. It's currently about somewhere between 9 and 10% of global electricity generation. No significant credible energy forecasters are expecting it to get back even to where it was at its peak, which was at about 15% in the mid-1990s. So some think we might get back up to, say, 13, 14%, but no one, as I said, is expecting nuclear to do the bulk of the work. It's the bulk of the work is being invested or put on the shoulders of solar and wind, where the expectation is that you will see the proportion of generation going from 13% or wherever it is today up to above 50%, even above 60% by mid-century. So that's the first thing, solar and wind, allied, of course, with storage, which we can talk about as and when we need to, and some form of base load generation that you can rely upon to generate power when you need it, until such point as storage has come on stream in a significant way. So solar and wind is the first thing. Second thing to say is that we are, for the most part, relying on the private sector to do this. Governments, for the most part, have essentially said the way we will be doing this, the way we are hoping this will be achieved, is by relying on the private sector to do this. Now, of course, that doesn't mean that governments aren't doing anything. Governments design and regulate electricity markets. Governments provide all manner of different support and subsidy mechanisms to try to incentivize private sector actors to accelerate decarbonisation, where it's not seen to be the case that they're doing so fast enough. But what governments, for the most part, are not doing, with some notable exceptions, and I think China should broadly be considered as one of these, and is obviously the most significant of these. For the most part, what governments are not doing is saying we're going to do this ourselves. They're not saying we're going to take this on the public balance sheet through public sector financing, public sector investment, and public sector ownership and operation of solar and wind farms. They are saying, you, the private sector, need to do this. We will help nudge you in the right direction where you need that nudging. That's broadly the approach that's being taken in most countries, including, obviously, the US. And then the third point, and very, very briefly, is that just as we are relying predominantly on the private sector, we are relying on the private sector operating broadly in its existing form, by which I mean there has been and continues to be no real significant reformatting of electricity industries and electricity markets as we have them today and as we've had them for the last couple of decades. So as of yet, there's been no real significant move to redesign the way in which electricity is bought and sold. We're relying on the existing structures, which increasingly around the world are liberalised, deregulated electricity sectors, which again we can come back to. So, with all of that on the table, why are things going too slowly? So the point with which I start in the book is to say that there's what in my view constitutes a dominant narrative out there in the world, which I think all of you will be familiar with to some extent and in one shape or form, which basically says, and this is a gross generalization, but I think it broadly holds, that the obstacles that are predominantly standing in the way of a faster transition in terms of decarbonisation are of a political/policy nature. And so just to give you some examples of that, which again I'm sure you'll be familiar with, the argument will be that things like slow permitting are standing in the way of a faster transition. It takes too long to get the necessary permits to get solar and wind farms up and running. It takes too long sitting in the queue for grid connection for those planned new wind and solar farms. NIMBY interests are too powerful in kiboshing new developments along these lines. Vested fossil fuel interests have too much power in shaping the decisions of transmission grid operators in terms of giving access to renewable operators to the grid, and so on and so forth. And the equally important part of that argument, the kind of flip side, is that what the problem is not is economics. And I want to just dig a wee bit deeper on that, because what the argument actually is there is that the problem, or at least a significant part of the problem, was economics, and what that problem consisted of was the fact that if you go back 15, 20 years in time, it was demonstrably much more expensive to generate electricity from solar and wind resources than it was from burning natural gas, or in particular burning coal. But then what happened from around the early 2000s, mid 2000 onwards, was that the cost of those generating technologies, principally due to developments in China, came down very far and very fast. And really by around the mid 2010s, we had reached the point in most parts of the world where it was as cheap, if not cheaper, to generate electricity from wind and solar resources than it was from burning natural gas and coal. And at that point, we had effectively solved the economics. We had got to this position of grid parity or better, where the so-called levelized cost of energy was as low or lower for wind and solar. And at that point, we had effectively solved the economics, and therefore it could only be the case that the remaining obstacles were of a political/policy nature, insofar as we can separate those two things. And I know that's a problematic distinction, but for the sake of argument, let's assume that they can be separated. And so the basic argument I make in the book is actually, I think, a really straightforward argument. There's a lot of kind of technical, wonky analysis that underpins it, which I hope is broadly credible. But the basic argument is a straightforward one, which is that that argument is wrong. And what I mean by that is not to say that those other obstacles in the realm of things like permitting and vested interests and so on and so forth aren't significant. Of course they're significant. They're very significant in many parts of the world, and they're somewhat significant everywhere in the world. So it's not to say those things aren't significant, but it's to say that the economics is also still a problem. And the basic argument there is that the problem is one of profitability, and that it's actually somewhat unhelpful, and in some respects very unhelpful, to look at the economics of all this predominantly through this cost lens, which has become the dominant lens through which it's understood and narrated. And that actually, when we look at it through profitability, the business of renewables deployment is actually just simply not a particularly attractive/reliable business in profitability terms. Now, I can say a lot more about that, but I just want to say two things in this limited time I have available. The first of those is to be clear about what I'm talking about. I'm talking about renewables deployment. So I'm not talking about the manufacturing side of the business, the manufacturing of the solar cells and the modules and the wind turbines. I'm talking about deployment, so the development of wind and solar farms, the ownership and operation of those farms, and specifically the selling of the electricity that they generate into the types of markets that I referred to earlier over the course of their useful life, which would typically be anywhere like 25 to 30 years before the equipment needs to be replaced. It's that business which has some very thorny and relatively problematic profitability characteristics. And of course, that's an issue, just to loop back to one thing I said earlier, insofar as we are relying on the private sector to do this. We are relying on a constituency which is nothing if not led predominantly, if not completely, by profitability considerations. So I don't want to say any more about that profitability argument now, but that's the basic argument of the book, is that there are some real problems when we come to profitability, and we can get into those more perhaps in due course. One final point I want to make before shutting up, because I probably will have gone on too long by then, is that, and I know this is a point that Adam has made before as well, but I think it's really important to emphasize, which is that when we think about this globally, when we think about electricity decarbonisation globally, the game, so to speak, is really not what happens or is happening or indeed will happen in North America or Europe. Yes, of course, what happens in those parts of the world is important, but it's actually what happens and is happening and will happen in other parts of the world that is disproportionately important, particularly across the part of the world that we typically refer to as the global south. And I just want to make 2 points about why that's the case. So the first of those is that on average, and of course it is only an average, the power sectors of countries across the global south are, on average, substantively more fossil fuel intensive than the electricity sectors of countries in the global north, even as the US has been pretty wretched on decarbonisation. On average, they are more fossil fuel intensive for very good and understandable historical, economic, political reasons, and so on. And then secondly, for all the kind of hoopla around AI and data center demand and so on, all reasonable energy projections globally suggest that the bulk of future global growth in energy demand, and specifically electricity demand, will be disproportionately concentrated in those countries. So you put those two things together, very fossil fuel intensive sectors and great future growth in energy demand, it makes it pretty clear why decarbonisation in those parts of the world is particularly important. Last thing I'll say, big part of the problem as I see it, like if you want to cut to the chase, is that it's precisely in those parts of the world where most needs to be done that the economic and financial challenges that I try and describe and lay out and analyse in the book tend to be greatest, not least, but not only due to the greater cost of capital in those parts of the world that really stands in the way of getting projects off the ground.
Yeah, and we will talk quite a bit, I hope later, about what the sort of picture looks like in the rest of the world. For now, I want to dig in a little bit to, I think, what I found so useful about the book, and I think what a lot of people have found useful about the book, which is as a way to understand not just the electricity sector, but the sort of broader approach that policymakers in the US and the EU, to a certain extent elsewhere, have taken here, most notably through the Inflation Reduction Act. There's versions of this in the European Union and elsewhere, but broadly, that Inflation Reduction Act, this attempt to sort of court private investment through about $400 billion in tax incentives for a broad suite of green technologies on sort of the premise that all of the sort of elements of decarbonization can be transformed into asset-generating objects or services. And so the sort of case of electricity, I think, is an interesting way to think through what that looks like in other sectors, and we'll talk about that in a bit. But just to sort of get us in a little bit of that mindset, I wanted to read a quote from former National Economic Council head Brian Deese, who's now advising the Harris campaign, describing the goal of the climate and energy-focused portions of that legislation. He says, it is meant to, quote, encourage private investment in clean energy. Tax incentives make the investments attractive, but businesses, along with rural cooperatives, nonprofits, and others, must judge whether investing their own money in a hydrogen factory or a wind farm will pay off. In the end, the law will only be as successful as our appetite to invest at a scale that will meaningfully reduce the emissions, warming the planet, and increase the nation's security. And so, we've had 2.5 years or so since the Inflation Reduction Act passed. The EU has taken on sort of their own and tried to take on their own sort of versions of this less robustly than in the US. And I want to ask both of you in sort of slightly different ways how you would evaluate just sort of the time since then, not just the IRA, but sort of as this green industrial policy zeitgeist has taken over among certain capitals in the world. So, Adam, I wanted to ask you, how do you evaluate the IRA and similarly imagined green industrial policy? And we'll talk about the sort of many goals at work behind green industrial policy, but specifically as a tool for decarbonization. Is the problem perhaps that these are just too small to work? The scale of something like the Inflation Reduction Act is too modest to decarbonize? Or are there gaps and fundamental design flaws in this type of policy?
Can I just say, can I say a word about the book before I start talking about American policy again? Because America does feature in the book, but one of the great things about the book is it's truly a global account. And because, as Brett was saying, I mean, he situates the dilemma that he's positing against the backdrop of a very succinct but very effectively sketched history of global energy regulation, global policy since the 1990s. This is a great book that should be taught on courses about neoliberalism, basically, because you give this summary of the way in which, and to hint at the US, in a sense, some of the more disaggregated models of electricity provision in the US and in the UK become models for other countries. And crucially, what we're talking about is a model that separates generation from network, from retail distribution. And it's in that all of the incentive, or many of the incentive problems are located. And this is a worldwide program, and part of the dilemma also of the Global South is that in there, the momentum towards further disaggregation isn't over yet, whereas in much of the rich world, we're actually headed in the other direction because the problems are so evident. And that's the kind of messed up matrix within which policy, including the IRA, has to operate. And Brett does a brilliant job of outlining the business model of Next Era and, you know, these players in the American system, which are crucial to understanding also the politics of the IRA. I mean, you're very restrained. It's a fascinating book also methodologically because you're so restrained in your analytical claims. And one of the things he shrinks from talking about aggressively is like why the IRA came to be the IRA as it is. And part of it is clearly the lobbying of intensely interested American green energy interests, and that created, as Tim, immortalized this phrase, bottomless mimosas is the muzzle, right? So this is a giant tub of extra subsidy. And what this book does more clearly and better than any book so far, and there's an essay also that prefaced this argument and spelled it out. Many of us got wise to what you were going to do in the book with that essay. It explains in a sense the self-contradictory logic of green energy development and green energy investment. And all of this is by way of prefacing my answer to your question, because the underlying argument is that this investment ultimately, new investment in highly efficient, low-cost green energy, renewable energy, in part because of its strange structure, which is all the costs are up front, then after that the marginal cost is pretty much close to zero, is a driver of declining rates of profit within the sector. Now, you could say this is true according to the Marxist analysis of all investment, right? And you're not a labor theory value of guy at all. You and Malm are on completely different planets in this respect, right? And that's read the new book, his new book. Yeah. No, I haven't read his new book, but just reading you on Malm, it's clear you're coming from very different planets. But in any case, Brett has his own version of a declining rate of profit thesis for the renewable energy sector. And so policy, in a sense, has to be evaluated, and institutional reform has got to be evaluated with regard to the question of how far it postpones that self-cannibalization of the sector. It's self-cannibalizing because basically in the modern disaggregated system, what happens is that generators install more and more efficient capacity, and then they're locked into these race-to-the-bottom auctions in which they basically sell electricity at cost plus some increasingly diminishing fraction. These auctions themselves seem pretty wild because people end up making crazy bids in these auctions, which lead to bankruptcies. But when you do that, the crucial thing is, because Brett understands the business logic here, the real question about all these projects is they're capital intensive, so how do you finance them up front? And no one in their right mind is going to lend billions of dollars on an asset whose value essentially depends on the highly uncertain outcomes of these bargains over electricity pricing. And if you're actually just selling into the spot market, you can literally look at 4x, 5x, 10x swings in the prices that the electricity command because of the weird way that the electricity market currently works, where sometimes it's gas plants which are the marginal supplier, in which case everyone makes out like bandits. But then when demand falls below that point, you suddenly crash to levels now where the electricity price can be negative. And no one, though we have this vision of Wall Street as this bunch of psychopathic gamblers, in fact, they're the opposite. They're super cautious in the way in which they hedge risk. And so, or even if you take on a psychopathic risk, you have to hedge it, and that's expensive. And so basically it's really difficult to get funding for these projects. And even if the levelized cost looks great, gas plants still beat out in terms of funding because the revenue flow is more predictable, also because they have this natural hedge whereby gas prices fall when electricity prices fall, and so the profit margins are more stable. And like, no one does the analysis of these logics as well as Brett, which is why everyone should read this book, because once you've read this, you have some glimmer of what's actually going on in the energy market logic. It's hugely compelling and fascinating. So policy has to be evaluated against the basic question of, does it fix this? You know, a nihilistic view, strong Marxist nihilistic crisis theory would say there's nothing that can be done. Furthermore, the political system is rigged in such a way as that none of the moving parts will move in a positive direction. I'm not in that space. You're not in that space. So the real question is about a move like the IRA. Does it address any of these basic problems? And I think because it was largely designed by lobbyists, by players within this system, as all legislation in the US is, it does help in various ways. And it helps crucially with the stability and the promise. I'm an IRA skeptic. I did all this trying to find its impact, and all of the IRA defenders schooled me on the fact that the crucial thing is exactly the problem that you identify, which is the predictability of the flow of subsidy. And basically the thing about the IRA from the point of view of investors in renewable energy in the US is that this looks like a longer term public commitment to a larger tub of more predictable subsidies, and that in and of itself changes the game. So it's not the glorious move into the post-neoliberal future that various people sell this as, but it is a tweaking at the margin of the subsidy system in a direction which is quite likely, and we see it. I mean, I really am a skeptic, looked hard at the data, but I think it's undeniable that, say, the Texas renewable pipeline, that is projects not yet finished, looks thicker and deeper than it was 6 to 12 months ago, and there are powerful reasons in Texas to do this with or without subsidy, but the subsidy really helps to make these projects more bankable. And the other thing that what we're seeing is that the American state with this subsidy regime, like other successful programs elsewhere, is in a sense beginning to help arbitrate an intercorporate, inter-elite bargain where the real stabilization for expensive renewable investment projects comes through corporate to corporate deals, where you have power takeoff agreements between Google, Amazon, and their ilk that basically commit to buying a certain amount of power at a certain price. And once that's in the project, an investment banker, a private equity person will say this is a risk that we can take, and the rest we can hedge out, or some subsidy system will absorb it. And so it's not the big, brouhaha around Jake Sullivan giving some speech somewhere explaining the logic. It's in the mechanisms through which these contracts are risked and de-risked that there is change. And there's no doubt, I think, that the Biden administration people have been well-intentioned, that they're serious about trying to get this going. They're smart. They're all from the corporate sector, Brian Deese being a case in point. They know what they need to deliver. And so this is the sort of inside elite bargain that offers us some chance of crafting projects that come closer to meeting what turn out to be the real thresholds. Is this, a viable thing for the decarbonization of the United States? No, right? No, I mean, no, but that you have to be operating at the level of abstraction of a Jesse Jenkins or somebody like that who's got some macro model that will allow you to guess that, and that doesn't mean that's for the birds. But is it? But precisely because it's so inside, I think there is some sense that these people may have tweaked this. Like the contracts for difference in the UK. Again, like classic, clever industrial economics. They figured out what would make, and it does make a difference, right? It has promoted decarbonisation in the UK. The UK shut down its last coal-fired power station, and America, the British were the first to operate a coal, not the US. The British were the first to operate a coal-fired power station in London, and they now have gone fully ended coal. So it's a sort of an interesting story to me about once you understand this frame, you have you provide us with the tools to actually articulate an understanding of the incentives that matter and not. And it's a very, very important. You should read Brett's other work for the same reason. Like his stuff on land ownership, his first book. I think it was your first, but first verso, but the one that came across from it has the same quality of of like pinpointing a really fundamental problem and allowing you to understand the mechanics of it in a way that you just don't get elsewhere. So like I really, really, as the Americans say, I really appreciated it. But like,
I along similar lines, Brett, I wanted to ask you, just since the IRA passed, I'm curious, just and in response to your book, sort of what you've heard from people within the industry as to, what has this changed, or what have policies along these lines changed in terms of the barriers. There's obviously, interest rates have gone up and then gone slightly down since the IRA was passed. There's been other, sort of supply chain constraints and other things. But what has been the sort of what have been the shifts that have happened since then, and how much of them have to do with this policy? How much is it helping, and what is it? Was it fixed, and what is it not?
Okay, I mean that's a difficult question for me to answer. Partly because, as Adam said, it's the my interests are not specifically in the US, but I know I definitely didn't, when I finished the book, I definitely didn't like kind of shut my ears to what was going on in the industry. I've tried to keep my ear to the ground a little bit, and I've had quite a lot of communication actually from people within the industry who have read the book and have reached out, which has been really interesting actually in that regard, insofar as a lot of the reaction has come from that world rather than the academic world. So the thing I would point out about the IRA, and it's a simple point, but I think it's one that's often forgotten, and I think it's really important to think about when one tries to understand what impacts it has or hasn't had, is that it's often when people talk about it, it seems like this came out of the blue into a landscape where there wasn't existing incentive. So it's not like the Inflation Reduction Act introduced a set of subsidies for the renewable sector into a landscape where subsidies didn't already exist. There were already subsidies there of broadly the same type that the Inflation Reduction Act has introduced. It's changed them a little bit how they work. But what was crucial, I think, was that it came after a period of great uncertainty about whether the existing subsidies were going to be retained, what was going to be done with them. And the industry was had found it very problematic that there was no long-term visibility about what was going to happen to that to those subsidies that already existed. So to cut a long story short, there were and still are a series of tax credits. Essentially, that's what the Inflation Reduction Act offers to renewables developers, either an investment tax credit or a production tax credit. And basically what the Inflation Reduction Act did was two things. Firstly, it extended them. It said, we have these existing subsidies. You all have not been given, to the industry, you all have not been given much visibility about whether these are going to be retained, whether they're going to be reduced, whether they're going to be wiped out altogether. And it said we're going to keep them for at least, I think it's the next 10 years or something like that. So basically they're here for good, essentially. So it gave that visibility. And then the other thing it did is it lifted the rate of credit back up to where it had originally been. So I think the original tax credit rates were 30%. For example, in the case of the investment tax credit, but it had been reduced sequentially over time down to like 24%, 22%, 20%. And they said, okay, we've seen what happens when we do that. Investment begins to stagnate, so we will lift it back up to where it was originally, 30%. And of course, what they were actually saying, although they didn't say it, was we're reinflating profitability. I mean, that's what they were doing there in order to get the investment to flow back in. And so when you think about it that way, as that it wasn't like a bolt from the blue that kind of introduced subsidy to a landscape in which it didn't exist, there was subsidy there already, but it buttressed it and it extended it. So when you look at it like that way, you shouldn't actually expect it to have done a huge amount because it wasn't fundamentally changing the landscape. It was giving the landscape a bit more security and lifting the rate back up a bit. But at the same time, since it came in, as Kate said, interest rates were going up all the time and supply chain costs were going up all the time. And so I think it's done broadly what you would expect it to do, which is help investment a little bit, but it hasn't fundamentally remapped the landscape. I suspect, and this is where I'm beginning to veer into territory where I'm much less knowledgeable, I suspect that the more significant stuff has not been about the credit or the subsidy for renewables deployment, but what what it's doing or isn't doing on the manufacturing side of the landscape in terms of, how is it changing the incentives that exist for renewables deployers in the US to buy locally from US-based manufacturing or to continue to import from Southeast Asia in general and China in particular. So I think, if anything, that's probably more likely where the significant changes are happen. Just one last point, because I think it's very, very relevant. One of the really interesting things, I think, about the Inflation Reduction Act is that as a form of support for renewables development, it's very, very different from what happens else in most of the rest of the world. Like, the US is kind of unique in how it supports renewables, and it's just, I think that's what, and Adam mentioned this, but elsewhere in the world, the main way in which governments have supported renewables development has been through so-called feed-in tariffs, of which the contracts for difference are essentially a new form, which is where the government basically says, we, directly or indirectly, will offer you, the renewables developer, a fixed long-term price for your electricity. We'll buy your electricity for the next 12 years at a fixed price. And then the developer takes that promise from the government and goes to the bank and says, look, now you can lend me the money because you can see that I'm going to be able to sell my electricity for a price that will enable me to repay the debt. And in the US, that's not what happens, which is why those corporate power purchase agreements are so important. The the tax credits don't offer that long-term price fixing, but the corporate power purchase agreements do. So essentially, the Googles and the Amazons and the Microsoft are kind of fulfilling the same role in the US that the government does elsewhere. Because in the same way, the developer takes the promise from Amazon and goes back to the bank and says the same thing. It just happens to be Amazon promising to buy the electricity rather than the government.
I mean, one of the great strengths of Brett's work is that he decomposes. It was really funny reading it. I said to a friend, it's a little bit like reading the account by a left-wing Martian anthropologist of how global energy systems work. And then he tells me he was a management consultant for a long time, and then the penny dropped. But the real virtue of this is it forces you to ask questions which you don't normally spend any time asking, which is, after you're reading your book, I'm just puzzled investment happens at all in capitalism. Like, at one level, it's just puzzling that it does. And I'm even more perplexed as to why particular things get done. Because one of the things your analysis allows us to see is that once you disaggregate retail sales, network, generation, and funding from each other into 4 separate steps, you've got 4 completely different, sociologically different groups of actors. And you've got some people who are heart and soul energy project developer types, men and women who spend their entire lives on energy. And that's what they live for, right? Then you've got network distribution, customer-facing people who have obligations to deliver power to folks. And then now we've got the corporate players who are Amazon that needs to look green. But regulating the whole thing, you've got somebody who's just got to earn more than 7% rate of return or more than 8%. And really, they could do it one way or the other, and they don't give a damn which way they do it. And, they've got teams of analysts whose job it is to, do the research, and they're invested in their niche of research. But ultimately, they can walk away from a project and just not do it. And that is the thing that really hangs over so many of the projects you describe. It's a little bit like Bruno Latour and the Aramis thing, the subway system that didn't find enough love. And in this case, one of your wind farms, for years, no one loves it. So it just doesn't happen. Whereas if you had a fully integrated system, you would have a compelling urgency. Say, this is, I think, also collectively what's going on in China. There's a connective, compelling urgency to massively expand power supply. Yeah. And it generates this collective momentum within the entire system, which is we need more power. And so this is in part going to be an engineer-driven process where the question is, where do we get money from to do this because we're doing it? And that was a really fascinating thing about this, about your study, which was that you segment it to such a level that you can see how tenuous at some level the claim on reality of any one of these projects at any given moment is, and how much we kid ourselves when we compose these beautiful images of, the inevitable triumph of solar and wind. I mean, I'm as much a sucker for this as anyone, like these cost curves, what they're actually saying is zero profit here, right? Nothing to be. This So it's one of, for me, the real strengths. But it does leave me with this question of comparison. Because if your ultimate argument is, renewables don't get done because they don't make money, my pushback would be, how the hell did fracking get done then? Because no one made any money in fracking for years, right? Or maybe I'm wrong. Maybe somebody did who was critical. But it would be so interesting to take your analytic and point for point compare it in the same space. You sort of persuade me that gas is a safer bet than a wind farm. I'm kind of, because of the hedge element. But when we pan back a little further and we look at energy policy in the US since 2008, we all know the big story is not the IRA. The big story is none of the renewable stuff. The big story is that America becomes the world's largest producer ever of fossil fuels. Yeah. And we also know that through the last 4 or 5 years, that was a massive cash drain. People were pouring billions down the drain into these holes, right? And it reduced the price of gas and petrol for everyone, but it was not making anyone any money. Or maybe I'm wrong. Maybe it was making somebody in your chain, someone's making money, and that's why it goes on happening. But I just want the Brett Christopher's comparison of like why solar and wind get stuck. Because from a European point of view, you've got no contrast, right? Because there's nothing happening in Europe. No one's investing in anything. Like, full stop. There just isn't any investment, right? Whereas in US, we have this live experiment of a world-transforming energy investment in fracking, and this lackluster, essentially, whatever, kind of experience on the green side. And with your analytic, we ought to be able to spell out why that happens.
Yeah. No, I mean, that's a great question, and I'm going to answer it in an unsatisfactory way, in the sense that I don't know enough about what happened with fracking to speak to that example. But I think you can sort of answer it by keeping the focus on renewables, which is to say, yes, the argument I make is that there's a real profitability problem here. And yes, the argument I'm making is definitely that is standing in the way of faster rollout of renewables. Yet nonetheless, there's a rollout. Yeah. Exactly. And I think that rollout can be understood in a number of different ways. So one of them, and I think that, and the reason I say this is I think that there are factors that often we don't necessarily emphasize enough. But I mean, I think in the renewables world, one of the things that's interesting, right, is that there are actors out there who are actually quite satisfied with relatively marginal levels of profitability. Yeah. Not least, but not only, because I think in many cases, not necessarily Next Era Energy's case, but in the case of smaller developers, there is a will to do something green. Yeah. Which I think which we should not underestimate. And I think those developers in many cases are quote unquote entrepreneurial entities. Yep. who are quite willing to accept that risk. It's the, as you said earlier, it's the financial institutions that are not prepared to take that risk. I think the energy company, the developers themselves, are often prepared to take that risk. And then the third thing I'd say is that I think that, and you've already hinted at this, but I can make the point more explicitly, which is that I think that in many parts of the world, not least Europe, the incentive mechanisms have worked. Like, contracts for difference, I think, are about as good as you get, yep. Given the existing energy markets that we have. Like, they do pretty much everything you want them to do, as long as the government doesn't piss around like in England and set the wrong ceiling price or whatever for the auction. And so I think they have done a really good job for the most part. And let's also, I mean, the UK case is really interesting here, not just because those methods of de-risking are actually pretty effective and as well as being necessary, but also the other thing that the UK case is really interesting for is that the UK has had a pretty effective carbon tax, specifically levied on coal-fired power stations. And that's, the likes of myself on the left often like to kind of poo-poo carbon pricing and carbon taxes and so on. But I think in that the evidence seems to me fairly clear that in this particular case, that carbon tax has actually played a significant role in accelerating the phase out of coal-fired energy. Yeah. So, I think that there's a lot going on there, but I think that combination of factors is what we should be looking towards. And just one, I mean, I think the other point that I want to make that doesn't necessarily answer your question, but it's a really important point. The kind of the comment you made about how investment takes place at all. I mean, I think that, you know, my own research I've done in the past, and the research for this book only kind of reinforced this view for me, is that, you know, so much of it in capitalism comes down to reliable and defensible sources of monopoly or oligopoly power.
Moats.
Yeah, absolutely. And, you know, and the one thing that is really, really noticeable in electricity generation, but specifically in renewable electricity generation, is unbelievably competitive, selling an undifferentiated commodity purely on price-based competition into incredibly competitive markets. And so here, you know, here is where you get to the kind of the counterintuitive thing. Well, hang on a sec, these costs have come down so far, how come profits aren't going up? Well, of course, if you're a renewable energy developer, say a wind farm developer that has seen your costs come down 60%, your generating costs over the last 10 years, you think, well, my profits must have gone up. But that ability to grow your profits is entirely dependent on your ability to kind of capture or privatize the benefits of those cost reductions. And in an intensely competitive environment, that's not what happens. They get competed away and they get passed downstream to later parts of the supply chain, or in large part all the way to consumers, because of course that's what politicians want. They're promising consumers a green transition while their energy bills won't go up, and even in some cases will go down. So on the one hand, as I see it, the policymakers are kind of caught between this rock and a hard place, where on the one hand they want energy bills to stay low because that's what helps keep them in power, and yet those very, very low energy bills are completely counterproductive to having the types of profitability that will incentivize further investment.
No, sorry. That's such an explosively unpopular argument. That's brilliant.
Yeah.
Because then you're basically saying we're taking the green dividend too soon. What we should actually be doing is like a Draghi-style strategy of allowing green monopoly capitalism to accumulate more surplus so that it can keep powering the investment, and then we somehow arbitrate the social bargain so we don't have fuel price crises. But basically, what we should really be doing is targeted low-income relief, and then the higher-income consumers should be gouged to feed that back up the chain to drive
absolutely.
investment.
That's the point, is that there are the distributional implications of it are significant. Yeah. But no, absolutely.
But that is, I mean, but that's the conclusion, right? Okay, there we go. No, you have this very strange combination in your thought of a kind of Marxist feeling political economy, like the move to profit. You in fact cite, you know, new school sources, and then on the other hand, this like, you know, this fine appreciation.
Don't label it, please.
Yeah, I'm not gonna. Okay, I'm not gonna label it. No, I get too much labels myself. But like, there's an appreciation of the logic of whatever, contracts for difference as a mechanism of steering.
I mean, I think that part of that, it comes out of a frustration with the argument that, like, we shouldn't be de-risking capital. And it's like, well, you know, if energy markets and energy finance systems continue to remain as they are, then if you don't de-risk, then there will not be any investment. And so for me, if the choice is between, on the one hand, you know, providing subsidy and effectively guarantees to BlackRock that they'll be able to continue to make X% returns on renewable energy investment, and you get a rapid transition, or on the other hand, you kind of take a pure position, say no, we can't stomach de-risking capital, and the transition doesn't happen, then I'll take option A every time. The problem is that we're limited to that set of options politically. That's the problem.
Yeah, I want to take us a little further down this road on basically this question of incumbency, right? That like in the U.S., which is like very particular in this way, we've had you know, some sort of impressive figures about renewables rollout to some extent, right? And then we're producing more oil and gas than we ever have, mostly due to the shale boom. Those companies were, you know, shale-specific companies were not making money before the pandemic. A lot of them went bankrupt, and now you've seen this sort of huge reorganization within the industry where they've figured out how to make money. They figured out how to balance their, clean up their balance sheets, basically.
And the big players have moved in. Exxon's moved in on Permian.
Yeah. No, they're buying up these big Permian players and big unconventional players. And so you have the sort of dual thing happening, right? You have a lot of, some well-deserved, some more like less well-deserved, sort of like trumpeting about what the Inflation Reduction Act has done. At the same time, a really sort of booming fossil fuel sector. Zooming out to the rest of the world, as Brett said, most energy demand is going to come from the global south, right? And
it's going to come from China in the first instance. I don't know why we're talking about the global south. Like, it's China that's the big driver here. It's not south. It's very much north of
China.
Yeah.
So how do we deal with this incumbency problem, right? Because the transition is not only sort of building renewables and then automatically canceling out. You can have these things sort of going upward at the same time. There's no sort of like inherent law that they will outcompete each other. And so what do we make of this? Emily Gruber and her colleagues have called it the sort of mid-transition, the problems of the mid-transition, right? Which is that in just sort of basic terms, that the fossil fuel system in a period of sort of uncertainty or I think decline, it's a bit generous, imposes constraints on a rising sort of cleaner energy system and vice versa, right? This is just a messy time. And with less planning, it gets even messier. And so when I want to ask, how do you both think about sort of building on what you were just saying, this problem, right? It's not only a problem of building out renewable energy. There's also this sort of gargantuan fossil system that looks very different in different places and could reasonably sort of, you could reasonably see the U.S. in particular, and I don't want to focus too much on the U.S. here, but decarbonizing to some degree domestically, at least when it comes to the power sector, where most reductions from the Inflation Reduction Act will come, and just continuing to export a lot, and have not to date, and we can talk about this more, been successful in these sort of piecemeal, just energy transition partnerships, global infrastructure partnerships, these sort of like, fig leaves given to decarbonizing the rest of the world. So yes, that is the question. What do you think of incumbency, and sort of what is, how can we think about what the other end of the spectrum looks like of getting sort of fossils out of the system as we build up renewables?
I mean, I obviously have quite a public, long-standing beef with interregnuming. And there's a moment in the book where you go, like, you touch on it, you have the Gramsci moment. Like, everyone seems to need the Gramsci moment. And that mid-transition stuff is like flagrantly, massively teleological. It's like we know there's a transition, and so we can define our current position in relation to the fact that we're halfway through. I mean, it's like, thank you for your confidence that is what defines us, is that, we're halfway there. It's an extraordinary construct, I think, of the mind in light of the trends that we're seeing, because we're not even started at the global level, right? That is basically... You've got the graph, in total primary energy consumption, the new renewable bit is this barely visible fraction at the top. To call this mid is just frankly bonkers. Mid would be halfway down. We're not even beginning to get there. So I don't get it. Like, it's a weird way of thinking about this problem. But I love the analysis. Yeah, I mean, the thing that really haunts me is if you look at just for sake of argument, to use a scenario, use the IEA net zero trajectories, as a baseline. You use them as well. Like, we've got to use something. And if you look at the two scenarios that, like, one's the rapid net zero and the other one's the slow net zero transition. And what's the difference between them? The difference between them is that in the rapid transition, the last gas and oil players standing are the obvious. They're all in the Gulf, right? Because they have zero. They're pretty close to renewables in terms of cost of production. They need revenue to maintain their budgets, but in terms of cost of production, they make profit at $30 per barrel oil. Yeah. So they remain in the game, and there is some residual oil and gas consumption. That's in the fast scenarios. They have nothing to lose, right? They're still there. The difference between the fast and the medium scenario is the position of the United States as the swing producer in the system. And as far as I can see, America's policy consists of aiming for a slow transition, which means that America never has to face what is otherwise just an yawning gulf between, professions about seriousness about climate and the reality, which is a massive doubling down on marginally viable fossil fuel assets, which are only really commercially viable if they can stay in that mid-transition. If Asia and Europe basically turn demand off quickly, it's a massive stranded asset problem. And so you can literally see it Russia and all the high costs, they're dead anyway in any of these scenarios. And so then one can imagine, I think, exactly as you say, a kind of bifurcated dualistic American scenario where the air conditioning in Texas is run off renewables, but everyone goes on driving the giant trucks. And then there is this huge export of oil and gas to a cluster of, folks taking maybe for petrochemicals in China. But China's not going to be buying, I don't think, a lot of oil for fuel, in the foreseeable future because the electrification is happening quickly. And that wouldn't be, we've had those kind of segmented political economies of energy in the US before, because in the 50s and 60s, the domestic American oil market was separate from the global market. And they were two, and the underlying cost price of oil in the US was actually high compared to the Middle Eastern oil, but they didn't compete. And the difference was then offset with tax, zero tax in the US and high tax everywhere else. So you can easily imagine a kind of spaceship fossil fuel American kind of, and then allies moving, and that would be a very slow and there's a Nature paper that lots of people read that actually kind of outlines this trajectory. So you can do the global models that map this.
Yeah, I mean, I don't have much of any substance to add to that. I think I'll say broadly the same thing, but come about it in a different way. So one of the kind of things I argue in the book is that that part of the economic obstacle that you have with renewables is in terms of the profitability problem is simply about the level of profitability. To cut a long story short, the level of returns is relatively low in the business of renewables deployment on average across time and space. But of course, I then say, well, returns is always a relative phenomenon. There's no such thing really as a meaningful absolute level of returns, because all capitalist actors have an alternative series of investment opportunities available to them, even if that investment alternative is simply not investing or leaving money in the bank or putting it in risk-free government securities. And the kind of the obvious comparator to make, and which I do make in the book, is to say, 5 to 8% returns, which is broadly what you're looking at in the renewables game, might look attractive to certain types of actors at certain moments in space and time. But the obvious constituency to which it hasn't looked attractive in the last decade or so is, of course, the big oil and gas companies, which in their main core upstream oil and gas business haven't gotten out of bed for less than 15% IRRs for the last decade or so. So people often ask, why aren't they? Why aren't we seeing the Shells and the Exxons and the Chevrons transitioning? Well, from a purely quote unquote rational economic perspective, it makes no sense at all for them to transition from a business where they're used to getting 15% or more returns to one generating returns of less than half that level. But of course, the last bit you need to say in that sentence is, for as long as they continue to believe that those existing levels of return in their core business will remain available. And that's the kicker, right? Which is when you get to the stranded assets questions. Because of course, if they believe that something is going to happen with that something most likely to be, I guess, regulatory action of some form or another that will impair that profitability in their existing business within the short or even medium term, then of course they would be looking at doing this. And so the really interesting thing for me looking at the last few years has been what's happened in Europe. I think there was a moment around about the kind of the 2018, 19, 20, where the BPs and the Shell, not the Exxons and the Chevrons, I don't think they've ever really thought about this, where I think the European ones were, I think they were actually, they believed, maybe you could even say they feared, that something was going to be done that would render their core businesses less secure in the medium term, not in the short term. And then you had this key moment, and reading the new Mound book that's just come out really made me think more about this. There was this key moment in 2021, which was, so in 2020, the BPs and the Shells had said, we are going to transition. Their transition plans were pretty modest, but they said, we're going to do it. We're going to reduce oil and gas output. We're going to spend more money on renewables. We are going to do this. We're going to become a different type of company. May 2021, the International Energy Agency, which Adam referred to, kind of put its stake in the ground, and it said, look, if we're going to hit net zero, there must be no new oil and gas developments, license for approval, and no new coal mines. And it was almost like the world kind of held its breath to see what happened. And then within like a week, 20 new oil and gas fields had been approved for development around the world. And it was just like new licenses showered like confetti around the world for the last two. And obviously the BPs and the Shells looked at that and they thought, governments aren't remotely serious about taking any of that action that we worried they were going to take. So actually, we're just going to row back on those plans, and that's exactly what they've done. And I think it's really striking that, when I started looking at energy seriously in the late 2010s, you heard a lot about stranded assets and but nobody really talks about stranded assets anymore for good reason, because it's fairly clear that none of them are going to get stranded anytime soon.
And especially in shale, the beauty of the shale assets is they're short-lived anyway. So it's not like big offshore Trinidad or something like that, which Exxon is also invested in.
Yeah, absolutely.
But the shale stuff is easy come, easy go, and they're getting a lot of the extra production out of increased efficiencies, lateral connections. But that's a very interesting point, because it goes back to the, like Mark Carney and these people who framed this up at the macro level. You don't talk about the macro level of this, but they have this Bank of England analysis of different transition paths. And the low-cost path, the optimal path, is the one that you're sketching was emerging. And I think the European elites had bought in on the Carney analysis. In other words, it's like a credible commitment thing with central banking. You basically do forward guidance. You say, this is the glide path. Believe us, we're serious, we're going to make commitments, we're going to do next gen EU, IRA, and then collectively there's an elite bargain, like no candy coating this, it's maximally profitable, minimum stranded assets, and we ride this and we make adjustments early. But then there's another box in this 2x2 in which you don't do that, right? Where you basically, everyone just proceeds as though there is no political transition risk until one imaginary shock of some kind happens, and then Angela Merkel does a nuclear thing, like she flipped over Fukushima, and the German electricity sector's never recovered from the hit they took when she basically forced the accelerated shutdown of the nuclear power stations. RWE used to be a titan of European industry; it's a shadow now. So, it's really interesting to see that play out. I wrote a lot of stuff in 22 around I called it like the climate Kalecki movement, in the sense that it was about creating this drumbeat of uncertainty, and arguing that like what was at stake here was the confidence of the sector, and you mustn't mess with the confidence of the animal spirits.
Yeah.
And so I think that would be a really nice complement to your micro analysis and its inefficacy, would be a reading that framed up these bigger narratives, which in the US just have no purchase. Yeah. Like none of that ever had any purchase on Exxon. The Economist had all of those, front pages going, do they not smell the coffee? And the answer is, what coffee? Yeah. Like that coffee? Like, it never even permeated, I think.
Yeah, I'll just say I attended, on the question of shocks, I attended an oil and gas conference in Houston, I think a week after Russia invaded Ukraine, and you could practically hear champagne popping.
Yeah. I mean, they must just have been.
It was wild. Yeah. I mean, I saw Amos Hochstein approach Sharif Souki, his former boss, to broker some deal or another. Yeah. But the atmosphere and all of the panels were titled something energy transition related, and all of the graphic design for the conference was green, and then in every room, this is great for us.
And that's got to be a magic moment, right? That December 2022 Hochstein intervention where he says it's un-American for the now privately controlled and profit-orientated fracking businesses not to ramp up their production because, on Brett's logic, it doesn't make any sense to ramp up production. Why would they? They've got a monopoly. They can just ride the price up and recoup some of their losses. And he literally goes to this, flag-waving nationalist line of like, no, we've got to save the American consumer from its extraordinary pivot.
And Jennifer Granholm begged the audience
Yeah.
to drill more. And Harold Hamm, who is being investigated by the Justice Department now for saying as much out loud, says we're not going to do it. There's no reason for us to drill for $200 a barrel oil, and we're not interested in it.
Yeah.
And that's what they did, and they're making fabulous amounts of money. I want to leave a bit of time for a Q&A, but to close us off, I want to. This is along similar lines, but sort of extending from some of the power sector questions, from energy production, more generally, this sort of green industrial policy moment is really focused on a lot of export sectors, right? And so if anything, I think it's, the way that things like the Inflation Reduction Act, the Green Deal, I think to a certain extent, and this has been seemingly a bigger conversation in Europe recently, is to protect legacy carbon-intensive industries. So cars in the United States, in Germany, there's some discussions about this in Italy. But I'm curious about this question of sort of that you raised, Adam, of just these like islanding kind of effects where the U.S. And sorry to keep talking about the U.S., but is sort of corralling other countries to reject very cheap Chinese solar panels, EVs, is sort of trying to build a coalition against cheaper imports for some of the elements of decarbonization, with cars, to my mind, playing a pretty particular role in that for some countries. But just where do you see this going, right? Where do we go where we have the U.S. sort of increasingly trying to build a multilateral alliance against China, blocking off sort of the things that would allow for cheaper decarbonization domestically, and to a certain extent trying to get other countries to join them in that. Is this going to be a situation where you have just very sort of bifurcated blocks of countries and alliances moving ahead with oil and gas production, or is there some sort of like more happier future in the offing?
Maybe just as a sort of general point, also another frame within which to think of Brett's book. I mean, one of the. I mean, it's such a pure. You really have this knack for like creating this little model. Kind of. It's a simple but therefore brilliantly illuminating approach, right? And basically, you narrow it down. It's electrification, it's generation, it's solar and wind, and whether or not they can be made profitable for investors. And then you offer this really compelling analytic of that. But if you think of the problem of the energy transition more broadly, another analytic that could be brought to bear would be Chuck Sable, David Victor, Cullenwood, right? And so their question is different from yours because they don't know the technologies that are going to solve the problem. So their problem is, how do you get the innovation that will actually set up your scenario? Because in your scenario, kicking in where the book does in the 2010s, especially with real vigor, we already know what the technological solution is. And you say, in a really illuminating way, it's not altogether obvious how we ended up thinking these are, but we are betting the house on this now, and it's too late to do anything else. But with EVs, that's not the case. When we get into all the other areas of decarbonization, all the hard-to-abate stuff, it's a really different logic. And what's interesting there is that the calculus of the strategic players, so if one applied your kind of analytic to those kind of sectors, even with the EV, it's very different, right? Because if you take the American bargain, you're basically, let's put it the other way around. If you're VW and you're following a Cullenwood and Victor kind of logic, in other words, so they do this great thing. So we used to think of the problem of environmental environmental disaster as a tragedy of the commons, right? The problem is there's too many sheep and we don't have demarcations, and so the sheep graze everywhere and eat all the grass. And if we had property rights, we would end up with a better management of the sheep and the grass, right? And they say, well, now that's not actually our problem. Our actual problem is what incentives, and so the answer, if you assume the problem is that way, is property rights and pricing, right? If you've got property rights and pricing, then the grass and the sheep will be properly balanced. But what they say, if the real problem is, how quickly can we breed a bunch of sheep that don't eat grass? Right? That's actually our problem, is like how quickly can we create, and what are the incentives necessary to create sheep that don't eat grass? If you're VW, that's your problem. Like, where is it that I am most likely to find the environment in which I will somehow solve the mysterious problem of actually making a Tesla or BYD-like vehicle? Because doing it at home in Europe, they failed, because this is an immensely difficult technological challenge. And it's not obvious anyone really has fully cracked it, but they know they're in the wrong space. So if they're not in China, I've spoken to a lot of those people, they have to be in China because they know it's the only learning environment in which they're actually going to be in the next phase of automobile. Same with BASF. Like if you're in the heavy chemicals game, there's really no reason to be anywhere else, right? You could be in the Gulf of Mexico, and they are there as well, but the two places you need to be is in China and in Texas. There's no point being in Europe, because you don't learn anything there, because it's not really a dynamic environment for heavy chemistry. So again and again and again, these players, Siemens the same, they have to make these choices. And so to answer your question, policy will only work if it offers a credible scenario that fits with a corporate strategy that says, yes, this works for me because somehow this American sealed off non-Chinese EV game is going to work for me and I'm not going to end up as roadkill. And right now that's an impossible sell. It's quite clear that basically America is just, and the local players are just opting out. I mean, Ford isn't a car company anyway. All it does is trucks, right? Oh, yeah. So, and GM is facing an existential choice, and Stellantis is a European firm. Essentially, that's where its real governance is from. So American policy has no hope of working on these players unless it can credibly construct. It can answer Brett's question, but in this case, it's a much more complicated question because it's not how is this profitable in a portfolio, but what is a viable corporate future for you? And that then requires this much more elaborate process of kind of collective envisioning because we don't know, really. We don't know green steel, how are we going to do that? No one knows yet. But what we do know is that China makes half of all the steel. So the chances of us in fragmented markets where we haven't really made steel hard for a long time, the chances of US steel ever doing are clearly zero, right? So, but if you're in the steel making thing, there's probably in the ecosystem of Chinese steel some bunch of genius engineers that may be actually working on this and can link it up with green hydrogen or whatever it is that you're going to do it with. And if you buy the American ticket of saying, no, that's not for us, cause whatever, you're taking such a huge risk. And that I think is going to be they just say it's about de-risking and profit margins. They're not understanding the seriousness of the strategic choice. The fact that Boeing can no longer make safe airplanes or that Intel can no longer make high-end chips is not a simple matter of rate of return, or rather, our best guess is it's because they thought it was a matter of rate of return that they can't do any of those things anymore. If you're actually on the other side of this and trying to not unlearn, if you're trying not to be a Boeing or not to be an Intel, why would you be in America? Yeah, if you're actually in the business of high-end manufacturing, why would you be in America? I mean, you can persuade the Taiwanese because it's Taiwan, for crying out loud. You can't. South Koreans are going to be harder to persuade. So South Korea can actually sort of defend itself because they actually have a large military-industrial complex, which they built as the Americans pulled out, right? So, I mean, these would be the questions, and I don't think American policy is even halfway in the space of understanding what these trade-offs are.
No, I don't really have anything to add to that. I think that the industrial policy and more broadly the geopolitical stuff is not stuff on which I have much to say. I think the only thing I wanted to add is just listening to what Adam was saying was that I think one of the things that's particularly interesting and notable to me is that if we think about what those corporate strategies are particularly in the US, but also in Europe, among the incumbents, and when we're thinking about the different technologies, I think it's pretty clear that insofar as at the same time, as they've been, basically either showing no interest in actual mitigation type technologies, or have been rowing back from commitments to those mitigation type technologies. The only real interest that those incumbents are showing is in the kind of negative emissions technologies. It's a colleague of mine, he's been spending a year down in Louisiana, and there's a heck of a lot of investment that's going on down there amongst the oil and gas companies in carbon capture and storage and so on and so forth. And of course, the obvious point there is that it's precisely so as not to need to transition that those investments are taking place. So I think that's where the investment is increasingly going to happen, particularly in the US, but also in Europe. And the interesting question there will be is how does policy interrelate to that? And I know that in the UK case, it's been pretty interesting with the new Labour government that they seem to be supportive of that trend. So that a lot of the money, a lot of the investment that Labour's been talking about in terms of climate policy is precisely towards those negative emissions technologies, rather than mitigation technologies proper.
And if you follow the Victor and Sable logic, the Gulf, the Gulf of Mexico, is going to be one of those hubs, right? Yeah. Because that is where America absolutely has critical mass. I mean, they have a hydrogen pipeline network already down there, right? That is far beyond anyone else in the world in terms of the sophistication. So, it's a similar hub of strength to Wall Street in finance, in financial engineering, or California in terms of big tech, right? Don't get me wrong, it's not that America doesn't have these hubs, it's just that exactly as Brett's saying, and it's not by coincidence that our friend Byron Deese's not green, but clean energy Marshall Plan specifies geothermal, hydrogen, carbon capture, and nuclear, which are all bona fide areas where America has advantage because nuclear is military industrial and the other three are directly linked to fossil. Yeah. So the Americans are very, 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 very good at drilling. And so if there's drilling-related stuff, America's going to be an absolute world leader in that. And that's appropriate. And we should welcome it and foster it and drive it hard, right?
Well, I had a question about this, because I've been thinking about this, and just quickly before we move to Q&A, but with something like CCS, these big pipeline networks, there's so much infrastructure involved in making this industry. I can't figure out for the life of me what the business model is for that.
Oh yeah,
right?
That's a whole other question. But if technological development, that's where it's going to come.
Right, but if as I read this piece Brian Deese wrote in Foreign Affairs in recent months, that basically the U.S. will create new markets for cutting edge clean energy technologies abroad, right? And so he focuses on hydrogen, he focuses on CCUS, all of which are fledgling, I think, to say the least. How confident are you that those will be, big export sectors for the U.S. and that the U.S. will do enough to put itself in a position where it, lives up to what he's saying in that, which is that we are going to dominate the world's green export markets for hydrogen and for,
I think some folks may know that I've spent the last couple of years struggling really hard with this question about how seriously one can take any of this, frankly, BS coming out of Washington at this point, right? And it goes to this point about, in the background here, there's obviously an argument going on with Daniela Gabor and her thesis and her critique of de-risking as a central way of understanding the current moment. And I think there are two different ways of thinking about that. And Brett's Brett's approach is the most direct, which is to say, look, what's the alternative? If we do de-risking right and we think hard about the distributional questions, we literally don't have any other tools. And my sort of more humanities kind of take is maybe it's all just BS. Maybe this is what I call the Potemkin duck. It looks like a duck, it quacks like a duck, but it isn't actually a duck. So when they say we're going to do all this stuff, we're going to have a green Marshall Plan, it looks, it quacks, it sounds, it's coming from the right place. But then you look at the numbers and you look at the concrete analysis, and it's just patently no one in their right mind can be taking it seriously. It's orders of magnitude too small. I mean, the Marshall Plan was a big thing. It was 7% of US GDP when you add it all up. Like that would be the kind of money we do need to be talking about. There's not a cat's chance in hell of that happening. If you're actually asking the more modest question of, could America become a major hub for innovation in those, frankly, kind of fringe elements of the green energy transition, then I think the answer is, with the kind of policy that Brett's analysis allows us to understand, of course it could. And Victor and Cullenwood and all those people will spell out how you do this, which is you find a first mover, you incentivize the first mover, you create penalty defaults, scaring everyone else into thinking that if they don't innovate, they'll be screwed. And then what you do is, crucially, you build a stable market. And you can do that in lots of different ways, but that is the thing. You need to create a bankable project. So it has to have a time horizon of 10, 15, 20 years. And that is going to involve some element of subsidy. And you need to bite the bullet on that, be clear-eyed about it, figure out the distributional bargain, not just for equity's sake, because it's only if the distributional bargain is explicit that will actually be credible. Because otherwise, people are going to imagine you're going to take it away again. Right? That you've got to get collective buy-in. This was the German... One thing the Germans did do right about the nuclear thing was they built collective consensus around it. Right? This was this early 2000s wisdom of saying, you're going to do a nuclear exit, you need to have collective buy-in. The only thing the industry was pissed off about with Merkel is that she accelerated the program they fully agreed to. So that is the sort of system that we need. Under those terms, can America be a lead in whatever those industries turn out to be? I mean, who else? Yeah. America really is world leading in sophisticated fossil fuel. This is the reason why the Shells and the BPs of this world are always looking for alternative strategies, because if you get up close to those people, they have such an inferiority complex, because they know that Exxon is the big daddy. Like, they're the big dog, and they have much better safety records. They keep their people alive better than the European operators. They're actually quite strict about corruption, unlike Total Fina Elf. They're actually top-end players. It's like going up against JP Morgan. You're going to have some alternative pitch. And that's the huge challenge for them. So yeah, America could be a huge lead in this, but it would take less of the bullshit and more of the sustained push, which is what we're seeing, right? Because we know the Petroleum Institute and the Chamber of Commerce have come out straight ahead and said, we want the IRA rewritten exactly the way it was provided for. We want all of those rules fixed, so it just becomes a giant engine for hydrogen subsidy. And that was part of the IRA deal. It always had that ambiguity, and they're calling that now and saying to Trump and those people, don't take this stuff away. It's great, because we are worried in some senses. We'd like to have technological backup. We would love to have taxpayer subsidy. Don't remove that.
Yeah. Let's take a few questions. I'm going to take a couple at a time. So let's go over here in the front. Yes, rugby show.
Thanks. So
and,
this is my
and I love questions.
Yes, it does have a bit
versus
of a preamble,
paragraphs of text.
but there is a question. It might be horribly naive, but so forgive me in advance if that's the case. I think you've made a very compelling case that, like at the micro level, green investments aren't all that profitable, and that's why they're not happening. But there's also the case, at least in my understanding, that like if we do not get our emissions down, there's also a serious long-term threat to the health of capitalism that the climate crisis faces, or that the climate crisis poses, that is not captured in a like micro-analysis of the sector's profitability. And people like Benjamin Brown were making this argument at around, or at least suggesting that it was a possibility around 2022, that if you're an asset manager, it would be in your interest to invest in climate investments and push for like the big green state, even if the sector itself isn't all that profitable, because you don't want that harm to the health of capitalism that the climate crisis poses. So I was wondering what you think of that. Thanks.
Thank you. Who else had their hand up over here? Right? And the beanie?
Thank you. So, might sound silly, but we ain't never running out of sunshine. Can Capitalism was born in the plantation system. It moved to a petroleum system, the plantation to petroleum system, the Renaissance and the transatlantic slave trader co-concurrent. It moved from there. Same players run the shit generation after generation, more or less. Okay, so we ain't never running out of sunshine. Capitalism is based on scarcity. Can our current market system accommodate that?
Thank you. I'll take one more. Nathan. Yeah.
Hi, everybody. Hi, Brett. As you know, I still have not gotten to reading the book, so I make my comments advisedly and in important ignorance, important respect ignorance. But I think there's been enough in the talk that I can push on this, which is the marketing of the book, and like the way I've largely seen you discuss the book is about markets in general. But when we get, 40 minutes in or something, and about profitability in general. But when we get further in, we hit this specific point that it's specifically how electricity markets are governed. So why is it about markets in general if it is about how this specific market is governed? Because there are plenty of markets that are governed where the price can cover the overhead cost in all sorts of different ways, and it's because the market's governed in a different way. And so totally was convinced before I heard the book, convinced hearing you talking about it, that this market governance strategy is pathological for these kinds of long-term investments, and especially large quantities of it in small points of time. But why is it about markets? Why is it about it being too competitive, quote unquote? Why isn't it about just this place needs a different market organization? And really what you're talking about is price stability. It's not really profitability per se, because profitability is related to price, but it's price stability, which is, as you know, talked or read when we talked about this, that administered prices are a key element of stability that create the zone for investment, long-lived investment. And it's not so much competition or not, because plenty of administered price markets are quote-unquote competitive. It's just not quote-unquote competitive in this way, which is a certain sort of pathological market governance that undermines its own viability. So
there were three questions there, two of which were, I think, directed specifically at me. So I'll let Adam have the one in the middle, which was I think was the hardest one actually, which was why I'm going to leave that to Adam. So the first question, I mean, as I understand it, the first question is like, why, if it is believed to be the case that the climate crisis represents a long-term threat to capitalism and the very nature of capitalism and its long-term health and profitability, then why wouldn't actors take act like asset managers that are invested across the length and breadth of capitalist economies? Yeah, take action now. I mean, I have a bunch of different thoughts on that. I mean, the first of those, which I think is a point that we shouldn't underestimate, is that those big universal owners are by their very nature passive owners. They are. 99% of their investment is entirely passive through index funds, and that's the business model. They're low cost, high volume business. But the second one, and I think much more fundamental to that, is that for those types of actors, some people working at those institutions might believe that the climate crisis represents a long-term risk to their health, but I think lots of people working at those companies would not be convinced of that argument. And then even if they were, the reality is that all of those types of companies, no one thinks that far ahead, frankly, in terms of. Sorry. Nobody is thinking that far ahead. They're not carrying out those investment, and pension funds might be different, but the asset managers, they're not thinking that far ahead. So I don't think that those types of kind of existential questions enter the terms of their calculus, to be honest. I mean, Nathan, in terms of your question, I mean, maybe this is an unsatisfactory answer, but the market framing, markets can't do that. That's the verso sort of marketing rather than my understanding of what the book's argument. But having said that, there's a really significant point there, and actually, and one of the things I didn't get to in talking about the overview of the book was what the different range of answers are out there for how to confront this problem, insofar as people recognise that the problem exists. And of course, there are lots of energy economists who are well aware that this is a problem, and the idea of market redesign is precisely one of the ways in which they would say you need to do this. And I actually have a degree of sympathy with that argument, because what they say, and they're completely right, is that electricity markets as we have them as they exist today around the world are constructs that were designed and implemented in and for a very, very different world, for essentially what was a fossil fuel world, and they remain, as I said right at the beginning, largely unreformed since then. So they make the simple point, which is that we need to redesign, update those markets to make them more appropriate for a different supply mix, a different world that is we are now living in. And if you do that, things will then fall into place. And I would just say two things in relation to that. One is that's always the argument. The argument there is that the marketization is not the problem. It's that we haven't got the market design right, but that a perfect market design exists out there. The second argument I would make was that there are plenty of alternative market designs in circulation that have been proposed by economists for the last decade or so. But not surprisingly, you look at those alternative market designs and begin to poke them, and all of them have as significant potential drawbacks as they do significant advantages. And to my mind, that's because there is no perfect market design out there. And the fact that markets remain essentially unreformed reflects lots of factors, including lobbying power and all the rest of it. But I think it also represents the fact that the perfect market solution has not yet been proposed that exists. So I don't like the market's framing as being the problem. And one of the reasons I don't like that, and then I'll shut up after saying this, is that the more time you spend looking at electricity and energy, the more you realise that markets are regulatory constructions. They are kind of bureaucratic thickets shot through with regulation and the idea that what we have in the electricity case is like a free market is itself a nonsense. It's completely a regulatory construct in the first place.
I mean, it's even worse, because Verso has really gone to town on this. So they don't just market it as a book about markets, they market it as a book about capitalism. Right? The subtitle is Capitalism. Yeah. So it's even badder, right? Because if what you say about markets is true, it's clearly also the case about whatever we take capitalism to be, is that it comes in lots of different forms and lots of different structures. If I might double down, but I am going to come to the sunshine point. But I mean, one way of reading the book is, because I was trained in economics in the 80s when they were doing this. In fact, if my academic career hadn't worked out, I wanted to be an electricity regulator because it seemed like a position from which you could do this universal capitalist thing. Lenin said, "What is communism but Soviets plus electrification?" Say, hey, one of the really interesting things that came out of that is that what's true about markets is also true about states, right? Because one way of reading Brett's book is to say it's an argument in favor of nationalization. I actually pitched an excerpt from his previous book to the board of a previously privatized Scottish power company, and one of their members afterwards took me aside and said, yeah, that's what we worry about all the time, that they're going to renationalize us. Right? So it's operating in this space. But one of the things we learned in the 80s when we were talking hard about what privatization would mean is that what Nathan reminded us about markets is also true of state governance. So you nationalize these, and then all of the questions are about which civil servants run them, under which rules, what your investment rules are, because one of the reasons why the British nationalized industries were sitting ducks for privatization in the 80s is they'd been run under absolutely terrible treasury investment rules that were every bit as prohibitive of long-range investment as anything that came afterwards. And so just amplifying your point, right? If we operate fully in a political economy space, then neither the simple state or market, big green state or, perfect market will get us anywhere until we actually talk about conduct, behavior, culture, norms, rules, all of the interesting stuff, right? Which also means if you believe this, then simple equations about capitalism are not his bag. So I'm not going to answer your question flat out with either my opinion, but I'm going to ventriloquize Brett's answer to your question about sunshine and the fundaments of capitalism and what makes it tick. And when I was teasing Brett earlier on about the difference between him and Malm, this is where this really comes out, right? Because Andreas Malm is your kind of guy. He fundamentally believes in the labor theory of value, which can take different forms, free and unfree. Right? And obviously in the colonial plantations, it took on this particular form of unfree labor. But he basically feels that problem, and he's following Marx here, right, gets extended in a new form to the factory system of Manchester and England in the early 19th century. And just to break a lance for Malm, his point is not that steam engines were cheaper. His point is not even a kind of Steve Marglin, neo-Keynesian or post-Keynesian kind of view that it was a matter of corporate control. It's much deeper than that. Like, as Malm is an operaist, right? Malm comes out of that Italian tradition of radical Marxism that insists fundamentally on the ungovernability of labor as the central driver of productivity and it's this metaphysical source of value, but also the great fear of capitalism, right? That ultimately where all the value comes from is outside your ken control. It's in the metaphysics of the labor process. And he has this sort of counter metaphysics, which if you can bring in not organic energy, that doesn't do the trick. But if you can bring in controlled fossil energy, you can explode that dilemma of how capital ultimately disciplines labor, not just in the trivial sense of like managerial control, but in this deep sense of substitute harnessed coal. You have a kind of alternative metaphysics of value, right? And this is not his bag at all.
as a side note, I've seen Andreas Malm speak a couple times this year, and it'd be fun to watch either of you debate him. But my actual question is, in terms of strictly the premise of the book or anything else that's been discussed, does the next president of the United States matter?
Hello, Brad. In your book, you pointed out that there is unwarranted hostility toward public support for green power production. I have come across some research that says that there's unwarranted hostility towards nuclear power. There's a lack of awareness of nuclear power based on thorium fuel. Apparently the reactors, they're much safer and there's much less radioactive waste. Do you see such hostility, and is nuclear power neglected in the green energy mix?
So I guess finally change it from dudes to somebody different. So I wanted to ask you, well, like, what countries do you specify when you talk about the global south? Because I come from, I guess my heritage is Nicaraguan. And whenever we think of saving the planet and I guess energy and stuff like that, I mean, I come from a place where we have natural disasters happening all the time. And people are like, oh, it was 7.5 the other time, 7.5 last week. So I guess I really want to know, what are you taught, what is your advice, I guess, on those countries? I mean, what can we do about them?
Three really good questions, and I'll try and offer some thoughts on all of them very briefly. And Adam will hopefully will agree with them as well. So I'm not sure if it is on. I speak quite loud anyway. I mean, I think so. When I use that term, the types of countries that I discuss as examples in the book with power sectors of the characteristics that I was talking about include India, Nigeria, Vietnam, Senegal, and I think that there's clearly a whole host of obstacles to faster decarbonisation of power sectors, which frankly have hardly decarbonised in many cases at all in recent years. But to my mind, far and away the most significant obstacle is simply the cost of private finance that's necessary to get projects off the ground in those countries. And so the basic model as it seems to exist today is that there's a reliance upon essentially subsidised finance, either from development banks or philanthropic institutions or whatever, to make the cost of private finance tolerable to developers to get projects off the ground. That seems to be the only answer that's out there on the ground at the moment. And there's A, that type of finance doesn't always work, and B, there's just not enough of it out there. I don't know what the answer is, but I do believe that that is where the real challenge lies. Not least because in so many of those countries that I've mentioned, we have governments that are operating under enormous fiscal constraints, horrific burdens in terms of repaying existing debt obligations and so on. So, but what the answer is, I really don't know. But I do think that that's a significant part of the challenge. In terms of nuclear, as I think I said, I don't focus on in the book. Not because I necessarily think that the answer should be solar and wind rather than nuclear, but because that seems to be where most policymakers lie. As I understand it, the reasons why nuclear is not more favoured seem to be kind of two or threefold. So one is that there are still existing safety concerns. There is a public resistance in many parts of the world to nuclear, which may or may not be well founded. There is definitely a cost issue. I mean, nuclear is comfortably the most expensive. And then I think last but definitely not least is the time element. So yes, smaller modular reactors can be built much more quickly, but you're still, you know, once you have the necessary permission, the solar or wind farm can be up and running very, very quickly, like 6 months. And that's just not true in the case of nuclear. And the one thing that we don't have on our side when it comes to the transition is time. So I think the temporal element was really important. In terms of the election, I've absolutely no idea how it may make a difference. But one thing I would say is that, which I think we shouldn't underestimate, is that when you talk to energy companies, particularly on the renewable side, because that's the side I know best, and particularly when you talk to energy financiers, the thing that they, in my view, crave perhaps above all else is like political and regulatory visibility and certainty and stability. Like they basically say, we don't, you know, the problem is not so much what the policy looks like, it's our ability to know what the policy is. And insofar as you think insofar as you imagine that a Trump administration would not be conducive to that kind of visibility and clarity and reliability, then that could be very, very significant, I think.
Yeah, I mean, that shows up. I mean, one of the really extraordinary moments of Trump's first presidency was those IMF studies about the impact of political uncertainty on global investment, and the variable they were using to proxy political uncertainty was Trump's tweets. And it actually had some, you know, I mean, it was a sort of silly econometric exercise, but it was showing up at that level, which confirms this. On the other 2 points, I think that on Nicaragua, I would have thought there the whole game, well, it's threefold. It's a country which still has huge poverty problems, and so it's a matter of access to electricity, and decentralized solar in that region is an amazing option. And we haven't spoken about batteries, but the combination of cheap batteries and decentralized solar is a huge win for the entire Caribbean region. And beyond that, it's all about adaptation and loss and damages, because both need to happen on a large scale. And the program which most, if you want to follow up on this, the Bridgetown Initiative is the way to go. It's still the non plus ultra in terms of the intelligent assignment of policy to targets. And it clearly identifies the position of vulnerable small players in the system like Nicaragua as pivotal, because it just, you know, mitigation is not really an issue for a country like Nicaragua, right? It's about electricity access, power access, substituting, replacing the diesel, the generators, which are everywhere, with cheap and affordable and long-run cheaper solar. So that would be the way to go, and I think the Bridgetown Initiative and everything that followed, that's where that's happening, and it is a problem that now at least has surfaced, but is under discussed as you're suggesting. The nuclear power thing, I was going to ask you about this. Did you ever in your research come across, because the moment where I began to think hard about this in the 80s was in the context of the miners' strike. And there was this brilliant work done by forensic accountants, critical accountants in the 80s in Britain, on the way in which the argument was made for shutting the coal mines. You know, the miners' strike in Britain in the mid-80s is, I think, certainly the most dramatic, comprehensive struggle over a just transition that we have seen. And if Britain has been able to end coal as rapidly as it has, it's because Thatcher won and the NUM was crushed, and therefore you're not in a German situation where you have a powerful trade union fighting a rearguard action. So it's a very ambiguous, from a philosophy of history point of view, it's a really ambiguous case, because this is an ugly story. But it produced a lot of really serious thought, and some of the really interesting thinking was actually about the construction of energy markets and the construction of energy balance sheets. And one of the invidious things the Thatcher government did was to play off the supposedly lower costs of nuclear power stations against the supposedly more expensive pits. And that was when this is 40 years ago now, but that was when I had an apprenticeship in thinking hard about how this works. Because everything comes down to how you account for, forgetting the nuclear waste issue and insurance, just take that off the agenda, because that's too big and it kills it stone dead. But if you just look at the business accounting, it's all about the capital cost. And what the UK Treasury was doing was allocating these, trivial interest rates to the huge upfront costs of the nuclear reactors, and thereby demonstrating that they were more profitable. And there was a journal at LSE called Accounting Organisation and Society, which did a bunch of really brilliant work on the on the logics which are so close to what you're describing, and I think really should be excavated. If there's somebody looking for an interesting thesis project, this would be really good stuff to look at, because it is about the same questions we're asking, but it was about mining communities, nationalised industry and its future, because the coal industry in the end in the UK was killed not by Tim Mitchell oil and all that stuff. It had nothing to do with that at all. It was built by the emergence of a global coal market for South African coal, for Polish coal, for US coal, for the big Wyoming mines. And that is this new phenomenon of the 80s. So it's as much about making markets as it is like handing things over to the market, which doesn't even exist in coal in the early 80s. In the current moment, what's really telling is precisely the kind of thing that you'd expect from Brett's narrative, which is, say you have got some venturesome technology that's got heavy upfront costs. How on earth are you going to make this bankable? Well, you need a corporate sugar daddy. And that's clearly what's happened with the nuclear sector in the US, is that these eco-modernists at the head of some of the big tech firms basically love the idea of powering their AI engines with nuclear power, because that's the 1960s, 50s gizmo future that they were promised as kids. And now they get to actually realize it. They're going to have an artificial brain powered by their own personal atomic power station that happens to be in Harrisburg. And it's just like, this is win, 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 bring this on, this future. And it only costs a couple of billion, so who cares? Right? It's not actually a viable energy policy, but if you really want to feel good about what you're doing and prove yourself, the German phrase for it is technologically open. That's the code, which in the German case is all things hydrogen. Must be given their head, because we wouldn't want to exclude obviously bogus technology up ahead of time, because that would be picking winners, and we know that's bad. Right? We used to anyway. You see what I mean? But that is, I think, that is part of it. And this, for me, is the story I really want you to tell us more about, which is there is the cost calculation, but in that cost calculation every time there is something else which Keynes called animal spirits, and that's what explains why people were willing to sink hundreds of billions of dollars in fracking, because they felt good doing it. And someone was getting rich along the way, but it wasn't macroeconomically sensible. And I think in the same way, there's a whole bunch of people right now who feel great about bringing the nuclear power stations back, and like putting two fingers up in the faces of the Greens, and but it's that whole story that what's it called, which is the institute, Breakthrough Institute, and and all these odious people, like this is their bag, and now AI is providing the excuse, and we got to do it, remember, because we all know that AI is going to be the huge drain on the this is a cascade of bullshit that's like sustaining this, and lots of billions at the end that provide you with the rationale. And hey, look. Why not? Fine. Like, we spend money on other things which are more wasteful. Why not give this a try? And I think it's a good idea to keep these technological frontiers open, but we shouldn't pretend it's a solution to the problem, right? That's not what this is. It's something else. And it, yeah.
All right, we are officially over time. Can I get a round of applause? If you want price wrong, 40% off, code market failure, and subscribe to Dissent, and that's 25% off. Thank you, everyone. Happy Halloween.
Okay.